Elon Musk sold $5 billion in Tesla stock, and his net worth dropped by almost twice that amount. That's not a mistake. That's the system working exactly as designed. Most people think wealth and net worth are the same thing. They are absolutely not. And the second you understand the difference, you'll never look at rich people's money the same way again. Here's the core mechanic. Elon Musk doesn't hold cash. He holds assets. Tesla shares, SpaceX equity, Twitter debt. These have a price on paper, but that price only becomes real money the moment he sells. Those are called unrealized gains. You own something worth $100, but you haven't sold it, so you haven't actually made $100 yet. The gain exists only on paper. Now here's where it gets interesting and slightly uncomfortable. The moment Musk sells even a small slice of his Tesla position, the market interprets it as a signal. Other investors get nervous. Tesla's share price drops. And because his remaining shares are now worth less, his total net worth falls by more than he actually received in cash. He sold $5 billion, but lost roughly $8 to $10 billion in paper value. This is called the price impact problem. But that's not even the strangest part. He still owed taxes on that sale. Capital gains taxes, which in his bracket on short-term holdings could consume close to 40% of the proceeds. So after the dust settles, he sold $5 billion, triggered a $10 billion paper loss, and handed roughly $2 billion to the government. This is why the ultra-wealthy treat selling as an absolute last resort. Instead, they borrow. You take your Tesla shares to a bank. The bank gives you a low-interest loan using those shares as collateral. You get spendable cash, and you never sold a single share, so no tax event occurred. This is the buy, borrow, die strategy. And yes, that's its actual name. You buy appreciating assets, borrow against them to fund your lifestyle, and when you die, your heirs inherit the assets at a stepped-up cost basis, wiping out the embedded capital gains entirely. Now you might be thinking, okay, that's for billionaires. What does this have to do with me? More than you think. Because regular people accidentally trigger the same wealth-destroying mechanics all the time. You buy index funds. They grow for 10 years. You need cash for a home renovation, or a car, or a business idea, so you sell. You've just done what Musk tries desperately to avoid. You created a taxable event and permanently reduced your compounding base. The wealthier alternative, which is increasingly available to everyday investors, is a securities-backed line of credit. Some brokerages now offer these to retail investors with portfolios as small as $25,000. You borrow against your portfolio at 3 to 5% interest. Your investments keep compounding, and you pay back the loan over time. Compare that to liquidating assets, paying 20% capital gains tax, and restarting your growth clock from zero. There's a risk, though, and this is crucial. If your portfolio drops sharply in value, the lender issues a margin call. They can force sell your assets at the worst possible time to cover the loan. This is exactly what happened to some investors in 2022. Even Musk himself was reportedly close to a margin call situation during Tesla's worst sell-offs. Having almost all of your wealth in a single concentrated stock is a high-wire act with no safety net. The takeaway isn't to copy billionaires blindly. The takeaway is to understand the tax cost of every financial move before you make it, because the government gets a vote on every transaction, and most people never factor that in. Wealth isn't about how much you make. It's about how much you keep and how long you let it grow before the tax man touches it. That single idea separates the people who build generational wealth from the ones who stay on the treadmill. If this reframed how you think about your portfolio, subscribe, because every week we break down how money actually works at the highest levels and what it means for your finances right now. And tell me in the comments, have you ever sold an investment and immediately regretted the tax bill?